On this question, 3.6a, we look at the required, you'll see they've got it broken into sort of three areas. One is the journal entries as they occurred, so the chapter 2 journal entries. Then we've got the year-end adjusting journal entries, and then we've got the subsequent journal entries. So what we're looking at right here at the end of year 1, 2021, we've got our financial statement date here on December 31st. So A, all these journal entries occurred throughout the year. Now on December 31st, we're looking at our trial balance. We're looking down our trial balance. We see that there's problems in our trial balance. Some of the accounts, due to the passage of time, are no longer correct. So we have to adjust them. And so these are all dated the same date as the financial statements, December 31st. Okay, and they're to sort of correct our trial balance. We're looking down it, and it's to correct our trial balance and make sure that all the accounts listed there accurately depict real life, the situation. Then part C takes us over into the subsequent year, and we look at the economic events measurable in dollars that occurred related to the transactions. So what I've done is I've organized mine a little bit differently. You probably started working through them and you did 1 through 7A, and then you did 1 through 7B, and then you did C for item 4, 5, 7, and 6. Okay. What I've done is just group them all together. I've grouped them all together just so we can see the entire topic at once. So your order is correct. My order is out of order. Okay. But I just want to do a complete discussion on each economic event on items 1 through 7, or series of economic events. So number 1, what we have is some supplies, and it says they amounted to $875. So we carried that forward from the previous year. Then during the year, they bought more, $1,900 more. And then at the end of the year, they counted them to see what was left over. So first, what we need to do is record the purchase of the supplies. First, we need to record the purchase of the supplies. And so we have the supplies right here. There we go. So we have the supplies right here being purchased on June the 10th. We're debiting supplies. It tells us we purchased $1,900 worth of supplies, and we pay cash, so we're crediting cash. This is a chapter 2 journal entry. Okay, it's a chapter 2 entry. Now, if we look at our T account, we can see right here, we've got the opening balance, $875. Okay. And then what we're doing here is we're purchasing more supplies from this journal entry throughout the year. So we post that, we put that one in. We're purchasing more supplies throughout the year. And now we're going to move ahead in time to December 31st, where we want to prepare our financial statements. And we count what's left over, and we see what's left over is $870. So the proper balance for this account should be $870. Okay, so 875 plus 1,900 equals, I don't know, $2,200 or so. Okay, or $2,700 or so, whatever it is. Okay, over $2,000. But we only need $870 in the account. Okay, so what we're going to have to do is we're going to have to credit this account in order to reduce it to $870. And our X, our unknown, is $1,910. So 875 plus 905 minus $1,910 equals $870. So in our adjusting journal entry, we need to credit supplies, $1,900. Our debit is going to go to supplies expense. Our debit goes to supplies expense. This is our Chapter 3 adjustment. This is our Chapter 3 adjustment. Okay. Any questions on that? The next one is
sorry, teacher, question. So since I think at the end of this year, we are doing some entrance adjustment, right? So on the item 1A, on June 10, I think this item should be, say, generally speaking, should be already in the general, right?
That's right. That's right.
So not market on the end of the year.
That's right. This journal entry was done in June. It was done in June.
Okay.
So then what would happen is on December 31st, we'd see an account that has $875 plus $1,900 in it. So the balance in that account at December 31st is, what is that? $2,780. And we're saying
so, okay, so this is that question happened. So, but say in reality, if there's a missing item, like on June 10, I missed, say, to enter this item, we need to do the adjustment again for this input. So the date should be marked June 10, or that should be the date we adjust at the end of year. You get my point?
Yeah, I find it hard to believe you would have missed this one because it's a credit to cash. So what probably happened is it went into an account, a different account by mistake. So what you would have is probably a correcting entry on December 31st. So probably you would do that entry on today's date if you're doing a manual general ledger, because you can't go back and do journal entries. And even in a company where you are allowed to backdate journal entries, an accounting system, usually they don't like that because all the work has been done already on the previous months. They've finalized their monthly financial statements already. So you would do it on today's date.
Okay, got it. Okay, thank you.
Good practice, yeah, because you don't want to mess up previous work that's been done. So the second one is we bought equipment for $43,000, okay, on August the 1st. So here, question number 2A, on August the 1st, we purchased equipment, $43,000. And it says we paid cash for it. So we debited cash. So this gets posted to the general ledger, this Chapter 2 account. This gets posted to the general ledger, and you can see we have a T account or a general ledger account called equipment. Now we move ahead in time to December 31st, and we're ready to prepare our financial statements. So we look down our trial balance, we see we have an account called equipment. We say, oh, there's probably amortization here or depreciation. So we see that the equipment is estimated to have a useful life of 12 years, and it doesn't say anything about salvage value. So we assume no salvage value. Okay, so our cost is $43,000 minus 0 salvage value. It says it's going to last 12 years. So divide that by 12. And what you get is $3,625 per 1 year, per 1 year. Did we use it 1 year? No, we didn't. We did not use it for 1 year, right? We actually only used it for 5 months. Remember the definition of an expense: used or consumed to help earn income. And then there's matching. We match the expenses to the revenues they helped earn. We didn't own this equipment for January to the end of July. So it didn't help earn any revenue. So from January to the end of July, there's no depreciation. We start our depreciation August 1st when we started using it. So for only 5 of 12 months. Okay, so we get $1,510. Now the actual number is $1,510.42. Sometimes in textbooks, they say you can round for depreciation because it's an estimate. Generally speaking, I don't really like to round for anything. Just read your required. Okay, read your required. Three. Okay, so here they put on 8 plays. Okay, and you'll notice that 4 of the plays occur before the year end. So by December 31st, we will have earned 4 of the plays. So 4 of the plays are earned in this area right here. And then the other 4 plays are earned early in year 2. Okay, so when they receive the cash, the $125,000, 500 times 250, they'll debit cash, and then they'll credit unearned revenue, because when they receive the cash, they haven't actually earned any of it yet. Now, as of December 31st, we move ahead in time to December 31st. We're going to look at that unearned revenue account on our trial balance, and we're going to say, oh, we earned some of that. And in fact, we earned 4 of the 8 plays. So what we're going to have to do is reduce our unearned revenue. So you can see if we post it into our T accounts, here's unearned revenue. Here's the 125. So what we're going to have to do is reduce it for the 4 of 8 plays that we earned. So we will debit unearned revenue and credit commission revenue. Iman, did you have a question?
Yes, Professor. Actually, I didn't understand how to put the entry for the chapter 3. Like you write unearned revenue, admission revenue, how it came, I didn't get it.
Well, unearned revenue, they tell us right here that the account that's used is unearned revenue. Okay, so if you're given an account title, go with the account title, use the account title that they tell us. Okay, don't think I saw anything for admission revenue, so I must have made that one up. But if they give you a name, it's kind of like, you know, your pet dog, right? Or your baby, right? If you have a child, if you name your dog Buttons, well, you'll always call your dog Buttons, right? If you're calling the dog to come eat dinner, you'll say, here, Buttons, here, Buttons, come eat, come eat. You won't all of a sudden start saying, you know, here, Fido, here, Fido. The dog won't answer. Same with a kid. If you have a baby, you know, and you start calling the baby, I don't know, Samantha, then you'll keep calling the baby Samantha. You won't change the name and all of a sudden start calling the baby, you know, I don't know, Kathy, right? The baby won't answer. The baby won't answer. So once you create an account title or a name, you keep using the same ones, right? Sometimes you're given them, in which case you use the ones that you're given. So unearned revenue is given, and I don't see admission revenue anywhere, so I must have made that one up.
Okay. Sorry, Professor, but I didn't get it. Like in that case, you just give an admission revenue by yourself.
Yes, I made it up.
But in just other case, like in next case, salaries expense, and you write salaries payable. I didn't understand from where the words I have to write. Like chapter 2, the salaries expense to cash, it is, I know from where it came, but for chapter 3, I didn't understand how to write the entry.
Is it the $62,000 you're not understanding?
No, the like I chapter 3 entries, how to put that entries. Like chapter 2, I can easily, when the cash is gone, it is in the credit side, and when cash is we received, it is in the debit side.
Right.
Like in chapter 3, what is the concept of the entries to written down?
Well, in chapter 2, you credited an account called unearned revenue for $125,000. On December 31st, you're looking at that account and you say it's too high. How much do we owe? Unearned revenue is a liability account. How much do we owe? There was 8 plays. We performed half of them. So we only owe half of that amount. That amount is too high. That amount is too high. So what we need to do is reduce this amount. How much do we owe? We owe half of this amount. We owe $62,500. This being the total. So we have to debit unearned revenue so that our unearned revenue account is correct. And here we're debiting unearned revenue. What does that 62,005 represent? It represents the plays that we, in fact, have already delivered, that we've earned. That represents the portion that we've earned. So our credit is going to go to our revenue account.
Oh, okay, Professor.
So number 4 is salaries. Okay. And I've got a little mini calendar down here. Okay. So here's Monday, Tuesday, Wednesday, Thursday, Friday, Saturday. And it looks like every Wednesday they pay. So payday is right here. Payday is Wednesday. Okay. And what's being paid? So here on, say, the 29th, what's being paid is, Monday, Tuesday, Wednesday, Thursday, Friday, the 20th to the 24th. Okay. And that's what they're saying is the last time they paid people on the 29th, they paid them for the 20th to the 24th, Monday to Friday. And they paid them $5,700 or $5,400. So you can see right here, December 29th, they paid them for the previous week. And so we've got a debit to salaries expense, credit to cash. This is our chapter 2 entry. So on the 22nd, we would have had the same entry and employees would have been paid for the previous week, which would have been approximately December 13th to December 18th-ish, Monday to Friday, the previous week, okay? And so every Wednesday, people are getting paid for the previous week. And so in 2021, the last payday is December 29th. So employees were paid right up to the 24th. They don't get paid for Saturday and Sunday. So now when we're preparing our financial statements, we look at this. Remember matching? Remember the definition of expense, used or consumed to help earn income. Well, we used our employees from the 27th to the 31st. We used their services to help earn the income. Did they get paid for those days? No. When are they going to get paid for the 27th to the 31st? Well, they're going to get paid on the 5th, on the 5th. Okay. If we go back to the accounting cycle, what's the first step in the accounting cycle? Well, analyzing the transaction. How do you know a transaction has occurred? Well, there's usually a source document. So when are we going to have the source document? We won't have a source document until January 5th, when they prepare the payroll. So we're going to have to add in or include these 5 days right here. We're going to have to accrue the salaries for these 5 days at December 31st. So on December 31st, let's add in or include the payroll from the 27th to the 31st. So we're going to debit salaries expense, credit salaries payable. We're not actually paying them $5,400. Okay. So we have accrued our salaries for the 27th to the 31st. Now, what's going to
Okay.
happen on the
Sorry.
5th, now this is part C, this is part C. Okay, what happens subsequently, this is C part 1. So what happens on the 5th when they actually pay the salaries? Well, on the 5th, here you can see January the 5th, the cash is actually going to go down $5,400. But we're not going to debit salaries expense. We already debited salaries expense. This is an expense for 2021. So we're going to, here we set up the salary payable here. So this is what we're going to pay, right? The amount that we have in salaries payable. It's now being paid. Make sense? So you notice on the side here, like, when I do adjustments, I always do T accounts. Okay. And it's an interesting thing, just like we said, people don't follow instructions, right? Which is critically important if you want to have success in your job. If your boss says, oh, I need you to do this, this, and this, right? It's a good idea to do it because that's how you move up within your organization. Okay. Another sort of thing is happening, and that is that people don't document their work. They don't show how they arrived at an answer. Well, in the case of an exam, a lot of instructors want you to show your work, right? If you want part marks, show your work. If you don't show how you arrived at an answer, it's all or nothing. It's gambling. Maybe you get it, maybe you don't. And some instructors won't give you full marks unless they can see your work. So get in a habit of always showing your work. In business, we call that, sort of, I guess, due diligence, right? If you are interested in, doing a certain thing or performing a certain procedure, opening a new line, borrowing money from the bank, you kind of put together your ideas and you write it all down. Then you come back to it and you look at it. You look at all your logic, you look at your calculations, how you arrived at that. You might give it to your partner and say, can you review this? Can you look at this? Right? Or if you want money from the bank, then you give your proposal to the bank and the bank looks at it. And what you're getting is a cold review, somebody else looking at it. But unless they see your assumptions, they can't even comment on your proposal, right? It's just words, meaningless words. You have to back up your calculations. You have to back up your assumptions. In the case of an exam, more so a paper exam, well, actually even exam online, show your work. Even if you use like scrap paper, show your work, because you can't review your work unless you've got your logic there. So, you want to map out your logic, do it on scrap paper and then click submit. Or if you can go back to questions, you want to be able to see, how did I arrive at this? Right? Otherwise, you can't review. You can't review. When you do an exam, if there's time at the end, you usually like to go back and look at questions just to make sure that it's correct. Right? And often, people do pick up sort of errors, but you only can pick up the errors if you've put down your logic. Okay. So now T accounts. T accounts are never babyish, right? If it was a paper exam, write them in the margins of your exam. Right? Show your work. How did you arrive at it? How did you arrive at it? So they're a tool. They're a tool. Sometimes you read your required. If they're in the required, then you have to use the T accounts or GL accounts. If they're not, it's completely optional. But also consider how will the marking be done? How will the marking be done? Do you need to show your work? Do you need to review your work? Do you need someone else to review your work? Right? So get in a habit of documenting your work. In business, you always need to document work, make notes about conversations, if you have a proposal for somebody or somebody agrees to do something, make notes of your conversation, right? Because if there's any kind of disagreement, you can go back to your notes and you can say, hey, no, I made a note that this, and this is how much you're going to charge me, right? You've got it all there. So make notes, always make notes. So writing things down is a very important skill in business, very important skill. Okay, showing your work, documenting everything. Next, 5, they rent the theater. Okay, so on December the 10th, you can see right here, they received $550 worth of cash. Now, this is kind of interesting, this question here. Some people, what they would have done on December 10th is they would have debited accounts receivable right away, right? So on December 10th, some people would have debited accounts receivable for the $250. Rent is actually $850. When they didn't get it, they should have debited accounts receivable, or many would have debited accounts receivable. If you did not debit accounts receivable here on December the 10th, at the end of the year, when you're preparing the financial statements, you have to pick up that other $250 that they still owe us. Okay. They have to pick up the other $250 they still owe us. Okay. Now the subsequent entry here, this would be B, this would be C. The subsequent entry here on January the 10th, what happens is they pay us for the next month's rent plus the $250. So they're giving us cash of 1050. Is our cash affected? Yes, it's going up 1050. $800 was for rent revenue for January. And the account receivable here relates back to this account receivable. Okay. And you can see how here with journal entry A and B, we got $800 in revenue in December. And you can see here in January, we've got $800 in revenue. Revenue recognition. We record revenue as it is earned. Any questions? Number 6. The theater borrowed on June 1st, $25,000. So the cash goes up $25,000. Is there cash involved? Yes. And then it doesn't say notes payable here, but they borrowed it from the bank, and the bank is always going to have a contract. And it's $25,000, and it's not paid back until May. So that's, it's June, due to May. So like that's almost a year. I guess it's exactly a year. So usually accounts payable is 30 days or 60-day short-term loan, but no contract, general promise to pay. This one here would have come with a contract. Oh, pardon me. It does say they signed a note. Did it say they signed the note? No. I put that in. So they borrowed from the bank at 4.5%. So this is when we borrowed the money. Now at the end of the year, what we're going to have to do is accrue the interest. You know, when you borrow money from the bank, bank doesn't let you use their money for free. You have to pay interest. So first we have to determine how many months. And so we're looking at June 1st to December 31st. So June, July, August, September, October, November, December, 7 months. Okay, so what we have to do is accrue 7 months worth of interest. So if we take the 25,000, multiply it by 4.5% for 7 of 12 months, we get $656.25. So theoretically, if we repaid the loan on December 31st, we would pay back the principal, plus we would pay back $656 in interest. Now in May, if you go down to your May journal entry, when we actually repay the loan, we have to ask ourselves, well, is there cash involved? We're repaying the loan. So yes, there's cash. How much cash? Well, we're going to have to repay this 25,000 right here. Okay, we're repaying the 25,000. Plus, we're going to repay interest. How much interest? Well, it's a $25,000 loan with 4.5%. interest rate. So we're going to have to repay in total $1,125. So our cash should go down $26,125. And you can see here the note payable right here. We're going to empty out that account, zero it out. It's no longer owing. Okay, so we'll remove that as an obligation. And right here, the interest payable, that's 656. It's now being paid right here. Okay, that's the interest that accrued from last year. And then now what we've got is interest from January to the payment date, end of May. Okay, year 2. So January to May in here. So January, February, March, April, May, 5 months. So if we take 24,000 times 4.5% times 5 of 12 months, we get $468.75. Okay. So the interest expense for 2022, the second year, is $468.75. And you'll notice that 468 and 656, these two summed up together equal the 1125. Right? So 468.75 plus 656.25 together, we sum those together. That's our 1125, right? There's our 1125, the total interest, right? 7 months from last year, the expense, $656, and this year's expense is $468.
Question, teacher. On form arise, so to answer this question, so do I need to mark the date on the date, like the year? Sorry, mark the year of the on top of the date, like the 20.
Oh, you know what?
22.
Yes, that's a really good point. Now my entries are all kind of jumbled up. Yeah, so we'd have 2022 here, and this right here is actually 2021, right? You're quite right. And so the general journal would actually be chronological, like it would be based on date, right? So you'd start off with your diary today, and then you do your diary tomorrow, right? And so if you make any corrections, it would be, you know, the day that you do it on. So you don't usually backdate in the general journal, right?
Okay.
Mine are all out of order. Just so we can discuss the full topic at once. And actually, when you guys did them too, they should have been mostly in order. I think they presented June, August. So this is here, I forget what month this was. Sold in July. Oh, okay, so not quite in order, but loosely in order they are. Right, and then you did in B all the December 31st entries, because adjustments always have a December 31st year end, and then January 5th, January 10th, January 12th, May 30th. So they tried to do them sort of in order, like keep the general journal in order. I reorganized it so we can discuss, like, you know, all of the topic, all of the events together for illustrative purposes. So 7, what's happening is we are adding in or including a phone bill. They realized they didn't get the bill, and going back over to our accounting cycle here, first step in the accounting cycle was we analyze the transaction, which is a source document. Usually we're looking at a source document, a business paper, a receipt, an invoice, a bill. We say, aha, we owe some money. But in this case right here on December 31st, there was no bill. So they had to accrue the amount to add it in or include it. So they did. They debited telephone expense, credited accounts payable. You notice they're not paying it. They don't have the bill, right? They don't have the bill. They're just adding it in or including it without the source document. Now on January 12th, when they pay it, cash is going to go down the $500. And it's going to come out of accounts payable, right? That amount that we owed is now being paid. Any questions on this?